Well, let's go ahead and get started.
Perfect.
All right, so very excited to talk to you. Today we have Alex Morris on the podcast. He is the author of The Science of Hitting and has written a spectacular book on Warren Buffett. Recommend you all check it out. It's Buffett and Munger Unscripted. Alex puts out spectacular research. I'll just go ahead and say, if you're a financial advisor and if you ever talk about individual stocks, which I don't know how you don't ever have that conversation, The Science of Hitting is a spectacular resource for you. You'll get really high quality information on the stocks that he covers, and it'll, at a bare minimum, you'll get awesome talking points with clients. So couldn't recommend it enough. So Alex, thank you for being here. Excited to talk.
That's very kind of you to say. Thank you. And we might get into this, but my life before launching TSOH Investment Research was spent in the RIA world for about a decade. So yeah, the areas I'm focused on is a lot of areas that I think a lot of RIAs are focused on as well. So I would agree with your statement. I'm somewhat biased, obviously, but I think there's a lot of overlap with what people are talking about with their clients.
Yeah, it's, so I was an advisor as well before I started doing this. Now I'm running a seminar marketing company for financial advisors. We do basically lead generation for them. And from experience as an advisor, high quality information is not readily available. CNBC, I think, does a good job. And, sometimes depending on who's on there, I love Squawk Box and obviously the Wall Street Journal is great. But as far as like individual security analysis, you're an awesome resource. I mean, you're not going to cover every stock in the S&P, but the stocks you cover, you're going to get great information from them. So what were you doing when you were at your RIA? What was your role?
Yeah, so the first place I went to out of school, which this is a while ago now, 15 years ago, time flies, was a really small firm that was basically getting off the ground. It was essentially the family's money of the individual who was starting the firm. And he brought me in as, I was an equities analyst technically, but I was also trading and I was a secretary and I was everything besides, he was basically the advisor going out and trying to find clients, and I was trying to help with everything else. Which for me was kind of perfect because I liked, even my start of getting interested in investing was really a lot of just going out and doing it on my own and trying to learn. So I was in that role for about 5 years, and it was a lot of sitting at my desk and studying for the CFA or just trying to learn how to be an investor, basically. So I did that for about 5 years. And then after going back to school and getting the CFA, I moved to a larger firm where I continued to be, and that role was a little bit more narrowly just an equities analyst and helping on the investment.
As an equities analyst, so a lot of financial advisors, when they start, they're really not introduced to individual stocks at all. And it's really not important for what they do. I mean, the best advisors I know, they don't need to know anything about individual stocks, frankly. I mean, the basics. When did you get put on? So often when you're hired as an analyst, you're, in telecom or you're in, big tech or, whatever it might be, energy. What was your role? Were you able to kind of move around freely like you do now? How did that unfold?
Yeah, more of a generalist. So as you just said, we had part of our allocations that would be either ETFs, indexed, or funds that we were allocating to, but we did have a bucket that was allocated to individual equities. So I was the main person doing the research in that space, which like the companies I cover currently, a lot of it was the companies that people will know by name or things that you can grasp fairly easily in terms of what is their business and what's their purpose for being. I've always found that to be a good starting point for trying to understand a company and to figure out where it's going over time. So that's something that's definitely stuck with me as time has gone on. I don't search for complexity. I'll wade through it if I have to, if something seems like it's really worthwhile, but it's definitely not where I'm naturally drawn.
So I'll just kind of jump back to, I actually discovered you a long time ago. It was right when I learned about Substack, really, which is where you can find The Science of Hitting. And I saw your title, The Science of Hitting, and immediately knew, okay, this guy's a Buffett guy. I'm guessing maybe you're a big Red Sox fan and that's where it came from, but I'm guessing you heard Buffett talk about that, the famous Ted Williams book. When did you discover Buffett? Was that always, were you taught to analyze securities like Buffett, or when did you become, a Berkshire guy?
Yeah, just real quick, stepping back. It is from The Science of Hitting for More, and that's how I learned about it. I am not a Red Sox fan. I'm a Cleveland fan. Kind of wish I was a Red Sox fan here recently, considering the winning streak that they went on. I wish we could do that, but we're not doing that. We're not doing that at the moment. Sorry, what was the other part of the question? When I first started learning? Yeah,
when did you get into Buffett? Because that was kind of my. Yeah, I think a lot of people have their it's like they find Buffett their own way, and then it either clicks and you join the cult, or you just say, oh, that's interesting, he does it his way, and then you move on. But it
Yeah,
sounds like you kind of went deeper.
I joined the cult.
Yeah.
It was when I was in college, and I think I was in my sophomore year, and a buddy and I had started getting more interested in business and investing in that area. I think we just kind of randomly stumbled upon it. I mean, obviously, if you're interested in investing, it's not going to take too long before you stumble upon something about Warren Buffett, right? But we both became really interested in it and obsessed with it, and we actually drove to the Berkshire. I went to the University of Florida. We actually drove to the Berkshire Hathaway meeting, I believe, the following year, which is like 25 hours each way from Gainesville to Omaha. And we were college kids with no money. So I think if I remember correctly, I've tried to block it out over time. I think we slept in the car a couple nights, 1 or 2 nights. And my mom was kind enough to get us a hotel for one night. But yeah, we were obsessed. And, it's funny, around that time, as I started learning more and more, one of the first books that was really impactful for me, I think I started with the Peter Lynch books, which I still kind of recommend to people to this day. They're so approachable, and I think it just helps get you in the right mindset of stocks and businesses and making that connection in a way, and again, in a way that's like really approachable for someone who's just getting started. But as time went on and I learned more about Warren and Charlie and Berkshire, one of the books that became really important to me was Larry Cunningham's The Essays of Warren Buffett, where he, for anybody who hasn't read it, he essentially took couple decades of shareholder letters from Warren Buffett and organize it by topic in a way that's really kind of digestible, more so than just sitting down and reading through 30 years of annual letters. So the book that you mentioned earlier for the Munger and Scripta, which I wrote, which is about the annual meetings, was very much based on that same idea and how valuable I found that book. So yeah, it was really during that period that I started to get really interested in this stuff. And then, yeah, it's basically been, as I said before, like 15 years of pounding away and making mistakes and trying to learn and get better, and also trying to take the lessons I've learned from them, and also realizing over time, okay, there's certain constraints they have based on particularly their size being a really notable one. I'm in the unfortunate position of not managing billions of dollars for myself, but that affords some flexibility on things I can do that maybe I shouldn't just follow what they do to the letter, right? So I found my own path forward over time as well, really in the last 5-10 years or so. So it's just been an ongoing journey of trying to take the same ideas and refine them and ingrain them more deeply in my process.
Yeah, your book is awesome. There's so many different directions I want to take that. Your book is awesome. I'm currently reading it right now. Even just yesterday, I was reading a passage, and it talks, Buffett talks about how we have different constraints than other investors have, and if you can play games, in the advisory space, everyone knows that mutual funds have a tough go at it, and compared to like the indexes, and there's a list of hard reasons why that's the case, but it's not because they're not smart, and it's not because they're not talented, but they have issues to deal with, particularly with assets coming in and leaving against their will, having to report, results every single year, fees, obviously things like that, taxes. They have constraints that don't have to apply to you. And so, finding a game that you can play where I'm not necessarily looking to outsmart, I guess anybody really. It's just, today markets are not doing well. I guess they were doing a little better than yesterday, but that doesn't have to impact you. And I think Graham even talks about that, using that to your advantage, where as opposed to people kind of get nervous and turn it into a disadvantage.
Yeah.
So when you're back at the RIA,
just real quick there, it's funny being in the RIA world. I came in as a 22-year-old or whatever I was, and being very interested in stocks and active investing and security selection and all that jazz. And, you go through a period of time and you go from being really confident and, in my case, somewhat stubborn. And as you get a little bit older, hopefully those things at least dull slightly and you start to see things a bit more clearly. But I also, came to really appreciate the actual value of an RIA business. And to your point, it's not, obviously people approach the business differently, but there's so much more to it than here's a bunch of money and try to beat the markets. In a lot of cases, it's not that at all. And there's a lot of value to be added through other things that, while they were not really they weren't what got me as excited as the stock portion of it all, came to appreciate just how important all these other pieces are and, the value that's provided from a really good advisor who knows how to do those things well. So you just start to see things a little bit differently as you start to get a more complete view of the world or an industry or whatever it may be.
I kind of had that journey as well, and I appreciate you sharing that. Because I'm an individual investor, I shared with you my portfolio. It's not a big diversified portfolio like an advisor would offer a client. I own, I think, like 9 stocks, and it's the most diversified I've probably ever been. But your average person, if they can buy a big low cost diversified portfolio and then combine that with planning, it's much better than they're likely going to do on their own. So I always say there's 4 smart ways to invest your money. Number one is be a value investor. The hard part is most people are not going to do a good job at that. And value investor includes good VC investing, good, whatever it might be, stock selection, maybe anything outside of day trading. But be a good value investor is number one. Number two is buy an S&P 500 index fund and just let it ride. Number three is build your own diversified portfolio. The problem is most people who try to do those things are not going to do a good job. They're either going to sell low, they're going to panic, they're going to purchase the wrong funds. And so the fourth way to invest your money, I would say, is to hire somebody to do it, have them build you a diversified portfolio and just let them coach you and combine it with good planning. And I would say the vast majority of people fall into that last category where, hiring help, it makes a lot of sense for them. So totally agree with you. I ran an investment center when I first started. Well, I was a member of it. And part of the challenge for me with picking equities was, again, money comes in and you don't always have good ideas when you have assets to invest. And it was kind of a challenge because I'm comfortable sitting in cash for 2 or 3 years sometimes. I mean, I've gotten a little more aggressive now actually, but it was a real challenge you can't charge 1% and expect investors to, just let you sit around waiting for an opportunity. Did you ever face issues like that with managing money for other people in that capacity?
Yes. Yeah. And I also think I've myself and from watching others, a few prominent examples of funds that I can remember, particularly during the mid 2010s when, it's kind of funny in hindsight, we fast forward to 2026. And I think in some ways it's easy to forget how loud the cries were during a period in 2012, 13, 14, 15 of stocks being extremely overvalued. I've pulled some prominent quotes over time from very well-known investors about, basically zero returns over the next decade. And you look back at what has happened, and that was at least as of now, a very bad call. And, I think one thing that I came around to the view on is it doesn't have to be this strict, but I have come to believe that a structural asset allocation really does make a lot of sense with some wiggle room around how structural it is, maybe 10 points in either direction if you want to have some flexibility. But getting into the world where you're 25, 30, 35, 40 years old and you say should be, quote unquote, should be 60, 70, 80% equities, to start getting really out of whack with that for extended periods of time, I just think it's a dangerous game. And I also think there's a component of constructing a portfolio and having the constraint of no cash that makes the decisions a little bit sharper. It definitely makes them more challenging. It's a lot easier to buy something when you have cash sitting there than it is when you have to go out and sell one of your ideas or trim a bunch of your ideas, whatever it may be. So I've come around to the view of trying to stay fully invested at all times, essentially. Fully invested in terms of a sensible asset allocation for a person or a family, whatever it may be. But then obviously constructing the portfolio in a way that is reflective of what you're seeing in terms of valuations in a given space or sector, whatever it may be. It's really challenging to do. I'd also say it's probably been challenging to do for 15 years now. So, I just think I think when it goes sideways, it can really hurt you to get really off sides. And the same would be true, by the way, of being too aggressive on equities, right? If the right number for you, again, quote unquote, right number for you is 60-40, and now you're at 85-15 because of how well stocks have done, you don't want to rebalance because of how well stock, like stuff like that is the same problem in the other direction, right? So I've become a little bit, at least personally, less willing to let cash really build up in a significant way because, again, maybe I'm just learning from the experience of my first 15 years in the business, but I just feel like it lends itself to some potential bad choices for long periods of time.
Yeah, it's interesting you bring that up. I would say last year I kind of turned around to that. So I think Ted Weschler has the quote when his I forget the leaks source, ProPublica, came out with his IRA.
Yeah.
And, surprise, surprise, Ted's a very good investor. He has a very large Roth IRA. I think it's like $500 million or something crazy. It's very big. And he kind of got out in front of it and said, yeah, it's true, and I've been saving. I only put in, whatever, 5,000 a year or whatever the limits are. And I know he said, rule of thumb is just always be invested completely in equities in an account like this because you have a long time. That was eye-opening for me because I did let cash build. I'd have like 40-50% of my portfolio in cash. And your portfolio is all individual equities and cash, correct?
Yes.
Yeah, I'm the same way, besides like 401k or stuff that I, just can't do. And I've kind of challenged myself to that as well. I'll sit like 10 to 15% cash, and then I just essentially try to put it to work in whatever my best idea is. It's been difficult. And, I was actually listening to your book last night, and it had me thinking about the Coca-Cola investment at Berkshire. If they needed cash to buy other investments, they probably would have sold some Coke and done better over time because they've actually underperformed, I believe, in the Coke holdings. And, maybe something like that is hurting them. Not that I'm going to sit here and critique their portfolio, but it's just a truth that, when you have to sell your worst idea to buy your best idea, that adds a level of complexity. And yeah, one of my worst investments, I should have bought way more, but I was out of cash and I didn't sell anything. So it was the Meta, and I think he put a chart up about it. It's around 2022 when I did it, or it was whenever Meta, when people were scared he was going to bankrupt them on the Meta spending.
Yeah, I think the name change was late 21, I want to say, but no, I can't remember. Either late 21.
It was right around then.
Yeah.
Yeah. But I bought eye drops of it. But I was totally confident, and yet I didn't sell anything to buy more, and now it worked out great. And for what? I had a meaningless sized position. So
that's the other thing I probably should clarify on the cash thing too. Like every discussion, none of this is black or white. I think part of the question comes back to also what type of investor are you? Like you mentioned, like someone like yourself, if you're someone who's going to have 10 positions and you obviously by definition are making fairly big swings as a result of having 10 positions versus someone who has 110 positions. And you also have a realistic constraint on yourself of, I'm at 10% cash currently. That's basically one position for me, or I'm at 15, 20 even. I'm going to put this back to work in a period measured in months, not many years. When it becomes a market call is when I start to get, I think it just starts to get away from what the actual objective of the structure should be. It's just too hard. And it's already
for a dip,
it's already hard enough to find investment ideas and to think about their relative attractiveness and to weight them in a way that makes sense, to then throw on an additional kicker of, okay, well now I'm doing that with assets broadly or with the market as a whole. There's just too many smart people who have made too many bad calls predicting market valuations and long-term returns. To the extent that you really hold that view, I think there's other ways to do it inside of a portfolio that still stays fully invested, that can give you a sufficient level of, call it, protection on the downside, but also on the upside. And I think upside protection is an important part of this game for individuals, let alone managers. I mean, as you were mentioning before, or RIAs, you look at someone like, just because he's the name of the day, not to pick on him individually, but someone like Terry Smith and Funsmith, like you go from a period of greatest things since sliced bread, like 3-4 years ago, to now, people ridiculing him in a lot of ways. And in AUM, I think he said AUM's down 50%, something along those lines. I mean, those are just very significant changes that even if it's in your own account, that would sting. When you're running a business, that's a whole nother ordeal, right? When your revenue base goes down 50% and you have to figure out how to stay afloat and keep your employees, et cetera. I just think those are kind of the relevant considerations that should be thought of along all these points of asset allocation, portfolio construction, individual security selection, having that all in the right frame.
Do you work with any RIAs currently? Do any firms pay you for research outside of the Science of Hitting subscription that's available to everybody?
Yeah, everything is through that. So I launched it in April 2021. So we just passed 5 years here fairly recently, which again, time flies. I launched it as, my pitch on what it was is effectively, yes, there's periodic research every Monday and every other Thursday. the way I tried to differentiate it was there's complete transparency on the portfolio. Any decisions I make are disclosed beforehand. And then I say exactly what I'm doing. I'm making ABC a 5% portfolio weighting, and I'm trimming XYZ in order to, so I disclose that to people. And that includes historic returns as well. And as part of it, I always included, essentially, to the extent that people want to talk to me, they can get me on the phone. So I make myself available to subscribers, to the extent that they need it. Hopefully the writing and the output's clear enough that not everybody needs to talk to me every day. But yeah, so that's kind of been the structure so far. And not to get too far ahead of myself, but I'm thinking about evolving the structure over time to do more things like live calls or mailbag and Q&A type things to maybe make this a little bit more explicit to people, that I want them to feel comfortable reaching out to me and viewing me as, I see myself as basically an outsourced equities analyst, someone that they can, to the extent that they need to, reach out to and talk to about any given name that I have knowledge on.
Yeah, well, your writing is good enough. They don't need to call you. And not, again, call him if you want to chat. It sounds like he's available, but the writing is good enough. If you're a financial advisor, I absolutely can imagine you will get your money's worth subscribing and reading his analysis. First off, just follow you on any of the socials. The charts you put up on a regular basis are just tells a quick story, because advisors, half the time, the way your average financial advisor is picking securities is sometimes they just need talking points with clients. They probably wouldn't describe it that way, but it is true. They'll have a 60/40 portfolio, low cost index funds, maybe some type of like long short fund or something, or a little bit of exposure to private, credit or whatever it might be, getting a little bit less popular these days, or the alts are a little less popular today. And then they have a handful of stocks, and typically it's the big name stocks, FANG, all of them, because that's what clients want to talk about. And you cover a number of them, and you can get great talking points from your research. And if you're a financial advisor, sounds like Alex is down to talk to you. Give him a call, subscribe, pay him, and then give him a call and just say, hey, what are some talking points for clients that I can, discuss on? You've written about Amazon, Microsoft, Crocs, all sorts of Dollar Tree, Dollar General, I think were big the last year, which I've talked a lot about with some of my investment friends as well. But that'll be useful to you talking to your clients. I mean, the average financial advisor, again, individual equities typically make up like 10% of the portfolio, and in that 10%, they might not own more. It might be like a 2% position or something along those lines, which is great. That's their strategy. But you can get really great information from the Science of Hitting. So highly, highly recommend it. Before we start talking about stocks, so from your RIA days, I believe I heard you say that you launched the Science of Hitting under a pen name because you were still registered. I did the exact same thing. I had a small Substack. I kind of left it, but went out under a pen name, started launching it and writing. It's a really fun way to actually just, when you're an RIA, you're very restricted. So it's nice to have a little bit of freedom. What was that journey like? When did you take the plunge? How long until you got some followers? Has your style changed writing wise? Can you talk a little bit about that journey?
Yeah, so it actually goes back to when I was in college. I started writing fairly shortly after I after I started investing. So that might answer part of your question on how good at least the quality of the research was, and probably the quality of the writing as well, because I had not done much of that either. But I started around that time, in a lot of ways, coming from the University of Florida, which is a good school. When I was trying to get a job in the industry and starting to reach out to people about internships and things like that at what I envisioned being a mutual fund or a hedge fund or something like that. I mean, I wasn't really well versed on the world of RIAs and things like that at that time. The response I typically got was, this is great when you're 25 and you have an MBA and a CFA, come back and talk to us. So I was kind of stuck in terms of, okay, I don't really know where to go from here. How do I get from A to B? So I eventually decided to start writing online as a way to start building my name a little bit and try to build my resume. Not too long after, the individual who runs Guru Focus, Charlie Tien, reached out to me about writing on their platform, and he had he was going to pay me a little bit of money, and it was a little bit of money at that time, but I was a college kid, so a little was plenty. So as I started writing on Guru Focus around that time, kept that going until I landed that first job I mentioned earlier. And then yes, my boss was saying, yeah, you can't be out writing, even though you're writing about Microsoft, whatever it may, we can't have you out there writing publicly about stocks. So that is when the science of hitting was born. And it lived on for about 10 years from then. And then when I launched a research service, I thought Alex Morris Investment Research or something like that just didn't really, people to some extent knew me as the science of hitting or TSOH. So I decided, okay, I'll go with TSOH Investment Research. So that's how the name got started and lived on through all those years. But yeah, I've been writing for 15 years. And I think I'm sure I've developed a certain writing style, and hopefully it's better than it used to be. I've also developed, I think you know this as someone who reads the work, developed a certain style in terms of how I present the research. I really think of it as, particularly for the companies that I've owned for a long time or followed for a long time, like you mentioned some of them, like a Dollar Tree or a Netflix or a Microsoft. I kind of view every article or update as it's a continuing conversation of what I've been talking to the subscribers about, and the conversation I'm even having in my own head. It's a continuing discussion about, okay, where is the business at? Where are we at relative to kind of the thesis I've laid out? What's happening, in the case of something like a Nike, for example, what's happening with Nike in China? What's happening with Nike in the running business? How are they doing as they now try to fight back against On and Hoka and these emerging competitors? So I view it all as like an ongoing conversation, which is really helpful for me, and I hope for readers as well, in terms of it allows me to make the writing a bit more concise and to really get to the point. And then I frequently link out to things that provide, like when I talk about Nike China, I'll link to things that I wrote 2-3 years ago that provide the basis for me saying, hey, in some ways, I think I kind of saw this a bit early, or whatever, whatever the insight may be. Hey, I was dead wrong about XYZ. It allows me to do it in a way that keeps the writing to a point where I can still get something on paper that I think people can probably read in 10, 15 minutes, as opposed to, I can't really sit and read things that are 40 minutes or an hour long, at least not like 3 of them a day. So I try to think of myself as the subscriber or the customer. And I just try to really get the points across in a concise way where people can hopefully digest it fairly straightforward. Point earlier on, the kind of things you had to say about it being a good fit for RIAs, again, I came out of that world. I think I have the mindset of a typical RIA in terms of like holding periods and the kind of discussions they're having with their clients. And I think about it very much in the same way of, when someone comes in and says, hey, it was down 10% yesterday on earnings, what's going on? I have the framing of, okay, this is a position we've held for 3 years, whatever the number is. And that long-term, what are the really important points without getting lost in the weeds too much? So I think it hopefully, again, is useful for subscribers in that regard. And hopefully it gets the main points across to people.
So we kind of talked about, on the writing, when did it pick up? So you have the signs of hitting, or I like how you went and got in trouble first and then decided to go. Yes. I like that style personally. That's how we do things at Nexruto. You would fit in around here, but so then you switch to the science of hitting. You say, okay, I got an idea. We'll do it in a way where you don't find out about it. And then how long does that take until you have like a following and it actually generates, revenue? You can turn to your wife and say, hey, I'm not just having fun here. We're bringing in a little bit of money, or at least getting your name out there. Because I know originally that's all you were aiming for.
Yeah, for a long time it was definitely supplemental and it wasn't. Maybe as you get to the late 2010s, maybe it's a number in the tens of thousands, but I'm not even sure that it was at that point in time. It's the period when I get to, late 2020 call it, and I look around and I see Ben Thompson at Stratechery, and I see Scuttle Blurb, who's a name in the finance space, and a few others. And I talk to people like him about the research business that they'd built and what the opportunity was there. And I looked at the role I had at the firm I was working for. I thought maybe if I launch something like this and I try to take this research directly to people and build a real business as opposed to something supplemental, I think that can probably work. And to the extent that it doesn't, I'll give myself a year to try it. And if not, I'll need to figure things out from there. But I think I should take a shot at doing this. So that's when it became a real business. And I've had to build it over the past 5+ years, and I spent a decade building my brand basically before that. That was definitely a hugely important like jumping off point, about as far from overnight success as you can be. But it was yeah, it took well enough in the first 6 months or a year that I was like, okay, there's something here. And I can go to people and say, hey, if you're committing, I think about a lot of my customers as being professional investors of one variety, and other RIAs, fund managers, whatever it may be. It's not the cheapest service out there, but I also think for many of them, the cost of the service is somewhat secondary to. I'm asking people to commit their time and to read this work. And I would personally be tentative about doing that if there was a risk of me disappearing tomorrow. In terms of the business, that's absolutely not going to happen. I'm going to be around. So I want to be able to go to people and be able to say that very clearly to them. Like, this is what I want to be doing. If you commit your time and money to the service, I'm going to be here. So yeah. And I've done a lot of things along the way too, to try to really make it be clear to people that this is very much a professional endeavor in my, full-time gig. So hopefully that's come across.
Oh, it absolutely does. So you had 10 years of writing though, where you're just exercising your writing muscles, becoming a better investor yourself, reading, explaining, basically being transparent with all your portfolio trades. And then around 2021, so a little bit coming out of COVID, you're saying, okay, let's see if we can get some revenue out of this. And it slow builds from there.
Yeah.
And for your, so a subscription, I believe is it like $800 a year, something like that?
Yeah. $7.99 a year.
Price to the other providers in terms of the quality of information you're going to get. I mean, the downside is, again, you don't cover 500 or 1,000 securities. But the ones you cover, you're actually going to get usable talking points, even if Alex is wrong and he, finds a dud or something, which, you're not going to go bat at, signs of hitting, he bat 400. So you're going to get great talking points and charts and just an intelligent conversation you can have with clients. So
yeah, I like to frame it sometimes as, if you want to go hire an equities analyst, what you should do still, you're between their salary and health insurance and all that jazz, you're probably going to pay them $800 a day, $800 per working day. So right. you can hire me for quite a bit cheaper than that, and I will be accessible to you if you need me to be. Not every day from 9 to 5, but I'll be there to talk if you need me to.
You should do speaking engagements. I really think so. I think RIAs would pay you to talk to their clients in like a dinner type seminar. If you're an RIA and you want to do a client event, I think bringing Alex in would make a lot of sense.
Yeah, I think you do really well with that. If you think it would make sense, I'd be more than happy to talk.
Yeah, I think it would be great for clients to really like it. Again, the hard part is, I'm sure you can talk intelligently about any of the FANG stocks and, probably any of the top 10 companies in the S&P, even if you don't follow them, you can't miss them. Obviously, you're aware about it. But yeah, I think that would work really well for you. And I think if you're a financial advisor, your clients will appreciate it. It's better than what they're going to get on TV or with their friends. And you can give them some great charts and stuff like that too, because you already have them. All right. How have you had to have thought about at some point opening up your own RIA, hedge fund, SMA, ETF? Have you considered that? Or is this kind of like a Taiwan Semiconductor, like you're just making a brand promise that I'm a writer, I'm an analyst for hire? Like we could get into making our own, but that's, you know what I mean? Have you thought about that or run into it?
There's a couple layers to it, which I wouldn't say I haven't thought about it at all. I think a couple things that come to mind are, one simply is, as I said, like I've been writing for 15 years now, but I've been investing for not much longer than that, which obviously is a decent amount of time. But I do really feel that, call it the last 5 years or so, was really instrumental in terms of building the muscle and really having clarity on exactly what I was trying to do in terms of the type of securities, in terms of position sizing, in terms of avoiding value traps. Like I think I've learned a lot of lessons about who I am, the type of investor I'm trying to be in a game I think I can win at, for lack of a better definition. So I wanted to get to a place, or I want to be in a place where I'm really, really confident about that. And that's been an ongoing development. Second thing is, it's funny, we're past 5 years since TSOH launched, but like getting a lot of the pieces in place in terms of marketing and a lot of the business structure, everything besides the research, it's taken a long time to get a lot of that going. So I feel it's a full-time job to just put out the research. It doesn't leave a lot of time for thinking about other things or considering other business lines or trying to find out other ways to go. So that's been another important. And the third one is I kind of view it as not being too dissimilar from doing the same thing. I mean, particularly in terms of maybe RIA would be slightly different, but in terms of, running a book, like I am running my own book and I'm disclosing it to people and they can do with that information as they see fit. But to the extent that I can do a good job at that and generate attractive returns, I'll feel accomplished in terms of at least the investment piece of it all. And again, like I just don't know how dissimilar that is at the end of the day from truly managing. I mean, obviously there'd be certain constraints with managing money that probably are not the same with just managing my own money, but in terms of the actual analysis of securities and constructing the portfolio, doesn't feel that different to me. So at this point in time, it's been something that I've had a couple people ask about along the way. And if the stars really aligned and it made sense to, particularly if it's something that I could do in addition to the ongoing research, which might be another challenge in terms of, legal issues or otherwise. So it's not something that's completely off the table, but again, I've been really happy with just running TSOH investment research and coordinating with or learning from subscribers and talking to subscribers, and it's just been a really fun journey. So I don't want to necessarily stop it for a reason that is not really well thought out.
Yeah. So every subscriber basically is like an $800,000 investment, right? If you charged like 1%.
Yeah, basically.
So in terms of,
and by the way, I should also note, people are grandfathered at the current pricing. So when I increase prices over time, which I have twice, people who are subscribed at the current tier or prior tiers, next time pricing goes up, they stay at that rate in perpetuity. So
that's awesome.
If their portfolio grows over the next 20 years and they still subscribe to my service from today till then, they'll still be paying 800 on, to use your example, a number that's hopefully a heck of a lot bigger than 800,000.
Yeah. So do you get the sense when people subscribe, are they just kind of following you and mimicking the portfolio? Are they using it kind of like how I talked about, like just, kind of pick the investments and, invest alongside Alex where he wants to? What's your sense of how the normal subscriber is working?
I think more so the latter. I think it's people who are viewing it as part of their, again, like an equities analyst working for them, and then ultimately they're ingesting that information and making decisions. I think for some of them, they may not even read a ton of the research, and they see one of my portfolio change posts, and then their ears go up and they go, okay, if he's sending me this, so he's making a decision on something. This is worth reading. Everything else I can do without, which is perfectly fine if that's the way they want. If that's the way they want to use it. But I think it's more so that people using it as part of their, again, like I think you kind of said this. They view it as kind of a high quality or a source of information that they can be confident that they can use in terms of their decision making or communication with clients, whatever it may be.
Yeah. So it is funny. I'm curious. I'm in an investment group, and we have like a WhatsApp group and we just talk. And a number of the ideas that pop up, I think some of the members of the group are subscribers of yours. And I just so I noticed that they might just be kind of parroting things that you might be writing about, which is a compliment to you. I mean, that's amazing.
Okay. That's allowed.
But it does make me, I do kind of want to ask a couple of my friends now. I was like, hey, where'd you come up with that idea? Are you flipping through value lines or
Yeah.
did you just see that on because I don't know. So I know they're talking like Dollar General and Dollar Tree. My group was talking about, and you've been covering them for a long time.
Yeah.
Yeah, there's a couple other examples. Ally, you talk about, has kind of got brought up. I have not purchased any of those, but yeah. So very influential. You're out there in more ways than you probably realize. But it is fun. Yeah, I looked at the SMAs as well because, my thought process was I'm doing this already. I'm managing a portfolio. The returns have so far been, compared to the S&P, have been, satisfactory. And, an ETF and an SMA sound good to me because money can go in and out, and I can just measure myself year to year as opposed to like when you put money in or out, which was the challenge when I was a financial advisor, is they're going to judge you based on their personal return, of course. But at least with an SMA or an ETF, you can do that. ETF, the hard part is it sounds like you have to be at 15 million to, break even, maybe make a little bit of money. So I wasn't quite sure I could get there quickly. SMA would work, but it would jam up Nexruto. And now I don't want to hurt the main business. So we've been kind of focusing on that front. Anyways, a small journey that we were looking into.
Yeah.
And so you're just happy doing the
My
research.
similar sense has been that it's really got to be something that the stars align to even consider it. And again, I have zero interest in shutting down TSOH investment research. So that's pretty challenging. Again, especially with full disclosure of everything, I just feel like there's probably challenges there that are just going to be too difficult to overcome.
Yeah. Similar enough. Nexruto is just too promising, and we're having too much fun kind of growing this, and there's just too many avenues that we're excited about going down. So I appreciate sharing that. I was curious why someone with yourself wouldn't just launch a SMA or something, because there's a lot of money in it, of course, but there's a lot of money in running a good newsletter as well, and inviting him for speaking engagements, which some of you guys should do. All right, let's talk about a couple individual stocks if you're open to it. So, I know you just read your weekly roundup. Next week, you have something coming out on Microsoft. Are you open to talking a little bit about Microsoft and the obviously today's I think it was the most market cap added to a traded company in individual day in U.S. history or something like that?
Yeah, which I owned. I owned Meta in the period when it was the company with the largest market cap drop in a single day. So now I have the distinct honor of having been an owner of both of those companies.
Was that recently, or was that
No,
like
that was at 22. The one time fell, the market cap went down. It was 700 billion or some crazy number, 400 billion.
Yeah, I was on the good side of that.
Yeah. Yeah, I held on thankfully, but unlike you, I was not buying more at the bottom. I was, the we can go into Meta later, but the FRL losses was a little bit concerning for me in terms of just how far Zuckerberg would be really willing to go. And the FRL losses remain large today. So in some ways that fear was justified. The core business has really turned around was the part I didn't totally anticipate.
Yeah, that was the part I bet on, but that was kind of the bottom line question was how much money is Zuckerberg personally willing to bankrupt this company and just bet on the metaverse, which ended up, it seems like a losing bet at this point. I understand what he was trying to do with getting off the Apple platform, essentially, and not having to pay anyone else's fees. But it was a question, will he? And now with these, look at Google today. I mean, now they spent all the cash and they're raising money. So all the hyperscalers are doing it. Obviously, it's for AI, not the metaverse, but same question in a sense, a little more proven, but yeah.
Yeah. No, absolutely. No, I mean, Microsoft, it's just to pick up what you were saying before, it's obviously a big part of all this. For me, it's a particularly instructed company because when I was coming through that period, when I was getting out of school and starting to save more money and actually being able to invest in practice, because you need money to invest. As I was coming through that period, Microsoft was one of the first companies that I started buying a decent amount of, or at the time for me, a decent amount of money. And that was in early 2011. And, it's funny, it definitely started as a very traditional value investment in terms of, hey, they have the Windows franchise, they have the Office franchise, they have this server and tools thing that I didn't understand, but they have these three businesses that overall seem like they're fairly good and stable going forward, even if they are not going to be growing by leaps and bounds. And you had a stock that looked cheap in terms of, I believe it was excluding cash, I think it was a high single digit PE. So I bought it through that very straightforward and traditional value investor lens. And, fast forward a couple of years and the stock had been in the low to mid 20s, I want to say originally, and didn't do much for a while. But then when you get to 2014, 2015, and they hire Satya Nadella as a CEO, and now the stock's up around, I believe, 50 or 55, somewhere in that area. And it's starting to look more expensive to the eyes of just looking at the PE, whatever it may be. And it's funny, it's a period where the company, I don't know if you remember this period well at all, the company was in the news, the financial news a lot in terms of this CEO process being kind of drawn out, and it's not clear who's going to become the CEO. A lot of commentary along the lines of this company definitely needs an outsider to fix things. The name Alan Mulally from Ford was thrown around a lot. I can remember that. He was an older man, but a lot of people said he'd be the perfect person for the job. And they hired this, I believe he was in his mid 40s, insider named Satya Nadella. And the response to him being hired, particularly just because he was an insider, it wasn't really as much anything about him, but the response was basically that this is a bad hire. And I can distinctly remember, and I've looked for this so many times that I can't find it. Somebody wrote a blog post about working for Satya Nadella. It was a smaller software company that had been acquired and rolled under the division that he ran. And this person's framing of who he was and his way of thinking about the world was just drastically opposed to kind of the caricature of who he would be as an insider. And I always remember that. It always stuck with me as something that was kind of really important and notable. And also, again, it kind of in some ways went against my kind of faulty interpretation of these ideas of the quality of the business and the quality of the management. This one's important. This one's kind of unknowable, or at least not what you should be betting on. It's the business piece that matters. And over time, my views on that have really evolved to how much of that is one piece as opposed to separate pieces, how much the management side determines the business side. But anyways, so you get through that period. And again, traditional value investors are at the point where like, okay, now this thing's at 15 times earnings, 20 times earnings, whatever. It's been a good puff on the cigar, but it's time to get out of here. The company then starts disclosing these cloud goals. And I believe it was at the 2015 Investor Day or late 14 Investor Day where they put this target of 20 billion in run rate revenue by 2018. I won't belabor the whole story, but the point of me partly saying this is it informed an evolution on my end of, okay, buying something cheap that's still fantastic. But there's some things that you want to continue to own as they get cheap, as they become more, quote unquote expensive. And the setup on those it's rare. It's rare to find these companies where you look at the CEO and the management team and go, I think this is top tier. These are top tier leaders, and the business opportunity they have, to the extent they execute, is fantastically large and very attractive. And to let something like that go because the turn on the PE multiple is 3 times higher or 5 times higher than, some other thing you're judging it against, I just really came to think that's a mistake. Again, like everything, not black or white comment there, but it's a mistake to be that tight on these valuation ranges if you're truly going to be someone who owns businesses. I mean, you effectively can't. You're going to trade out of everything if you think about it that way. So anyways, fast forward to now, it's something I still own in a fairly sizable position for me. I basically I've trimmed very infrequently along the way. It's had a tougher run here recently, and some of which in my mind was not undeserved. I think their strategy and the clarity of their strategy and their relationship with OpenAI in particular it certainly felt like it was souring, and their position relative to the other hyperscalers and relative to the frontier model companies just felt like it was changing in some ways that was presenting risks. And that's even before considering these massive CapEx outlays that are basically happening everywhere. So I guess the final thing I'll say, is this quarter, it's funny. I think we got one of the things I'm really focused on as it relates to Microsoft is the M365 commercial cloud business, which, I mean, you could basically think of the main component of it is Office. And now it's them pushing Copilot and some of their knowledge worker AI tools, and also this new premium tier of their offering that they call E7. So anyways, the point being, they're obviously spending a lot of money up front to build better tools and to invest in this. Now they need adoption and actual revenues to show up behind. And if you go back 2-3 quarters ago, one proxy for looking at this is the level of revenue growth in that business and then the level of seats growth in that business. And obviously that spread tells you something about the net pricing, right? Per user, per seat. That spread was not widening as much as I thought it probably needed to suggest that they're really having meaningful traction here. And we also didn't have great numbers on the number of seats for people with Copilot anyways. This quarter, they came out and said they've surpassed 30 million seats. That's up 10 million seats from 90 days ago. So they're really starting to pick up speed here. They're seeing adoption with that E7 tier I was talking about. And I just think just the commentary on the call, and I'd recommend people, if they didn't listen to it or read it to the extent they care about Microsoft, I think this one in particular is worth listening to or reading. There's just a much clearer and more forceful expression of what role they play in the ecosystem and what role they play for particularly enterprise clients relative to an Anthropic or an OpenAI, whatever it may be, and what they can do that they're uniquely positioned to do. So yeah, it was, it's funny. I've obviously held it for a really long time, so I've navigated choppy waters periodically with Microsoft, but this period did feel a little bit more like, okay, there's things to figure out here. Company needs to figure some things out, obviously within the context of a massive business that's hugely profitable. But I feel like it's one of those days where the stock was up, as you said, largest single day gain for, I think it said, a U.S. company in history, up 16% or something. And it's one of those ones where you look at it and go, yeah, I think in some ways it's probably deserved. It was a pretty important moment for a stock that had been beaten up pretty meaningfully.
Yeah. The their AI strategy, at least from our end, feels very Microsofty. It's not the model you want, but it's going to be included in the subscription you have to get, and they're going to charge you more for it, and so you're going to pay it, and now you have their models and you're using them. So like in our business, we do seminar marketing, and we create high quality presentations for financial advisors, and so you have to do that on PowerPoint, right? You don't send them a Canva or whatever. Like, you send them a PowerPoint. That's point blank, period. And for the most part, you also kind of need to send them Excel sheets every now and then for, random one-off thing. We don't do a ton of things where we would need Excel, but every now and then something pops up, like whether it be an advisor's follow-up tools they do in Excel or something, who knows. But we need PowerPoint. Because we need PowerPoint, we had to move everything from Google Workspace, which is where we're doing our emails. Now we're on Outlook. We have PowerPoint, Word, Excel. We switched off of Slack. We're on Teams now because we were forced to pay for it. So all of that just kind of came with it. And that's it. You're signed up. They did not force us onto Azure. We're still doing stuff with AWS. So I don't know how or when they might, make that worthwhile, which I guess they do include that in the Azure revenue. So like when they book revenue, my subscriptions, whatever we pay them goes to that. But yeah, it does feel very Microsofty, their AI strategy, just kind of pushing Copilot into things, whether you asked for it or not. We'll see. But
yeah, one thing that's been I think it's somewhat related to that comment. One thing that's been challenging, I mean, this goes back a decade now, has been just trying to really get it. When the goal was 20 billion in 2018, at the end of that year, they were at, I think, 27 or 28. It sounded like a large number at the time.
yeah.
It's definitely not a large number now relative to what the business is doing. I mean, I tweeted something yesterday about the Microsoft Cloud business over the past 10 years grew at a 35% annualized rate, starting from at the end of fiscal 16. They just ended fiscal 26. It was at 12 billion. Are you familiar with base rates or the base rate book by chance?
No.
It basically shows, it's a historical data set of, okay, historically there have been X number of companies with $5 to $10 billion of revenues. What percentage of them grew between 0 and 5 and 10 over the next 10-year period? If you look at base rate, and you can get a sense for, what has been achievable historically, at least for a company of this size. Base rates on a company starting with revenues of 12 billion, growing at or above, I can't remember if it was 35% or 30%, but growing at or above that number over a 10-year period was 3 out of the 3,900 samples, or whatever you want to call it, data points that have been. So this is just stuff that is basically, you've never seen anything like this, right? And I think Andy Jassy on Amazon's call yesterday said basically that they think AWS is at some point going to be $1 trillion business in terms of revenues. So that's just been and I think this happens a lot, particularly with companies that are in a period of structural growth. If it's a new market and you're trying to be a value investor who doesn't want to get too far over your skis on value, how do you think about that and manage that? And it's been really challenging on Microsoft along the way. I think at a point in time, maybe when they were at 30, 40, 50, 100 billion, you still think, okay, in terms of enterprise, you can obviously find some numbers for things like this, but enterprise IT spending or numbers you're going to find very big numbers that are more than 50 billion or 100 billion. Gets more and more challenging as time goes on, but it's just funny to think back to, you always have this sense of like, okay, but what do I do now? And you just forget that you had that same exact thought, 20 times every 6 months for the past decade.
I 100% had that thought when a number of purchases. So like, particularly like for Apple, when I remember when I purchased it in 2018 or whenever, and then it became the world's largest company. And it's like, well, how much bigger is the world's largest company going to get?
Right.
Turns out a lot. But
yes.
Same with like Google. It's like, well, how much bigger can it get? It's just search. It's just clicking. Turns out a lot. And, part of the question, especially like Microsoft's facing this too in a little bit of a different way, but like a Google, for example, the question is always like, Buffett, in your book, I was listening to this the other day. I'm doing the audiobook, so I keep saying listening. You want if you have a business, like Buffett talks about seize candy, and if you can continue putting billions of dollars into it and earning attractive returns on capital, you would like to keep doing that. But with a C's, if you put $20 billion into C's, you're just going to lose $20 billion. But if you just let it sit there, it's going to keep spitting out, I don't know, a billion or two a year. I don't know how big it is. But so Google, they were spitting out capital for years and years and years and years. And all the big tech companies they were just growing capital. And now they've finally found something that they are in a major way dumping that capital into. And the question is, are they going to earn, what returns are they going to earn? It's not going to be search returns. So for like in Google's sense, what do they return? Do they get 35%, 25% margins? Or, AWS, I think, was making like 50, 60% margins, I think, at a point. So are they able to earn that in a big way? Because if they can, then yeah, these are going to be the best investments ever. If not, you just kind of spent all the search money on, or in Microsoft's case, whatever it might be. So yeah, I mean, the bull and bear case just screams at you. It's such an interesting time. Like Google, for example, on the one hand, they just bought back, I think, $100 billion of shares and then sold it back into the market up 100%. So,
Right.
That's spectacular. So you're happy with that. On the flip side, now you're spending all the money and you look like you're going to kind of pick it up. So, and is this going to kill the search business? Nobody knows that answer for sure. For decades now, the thing with Google has been the more time you spend on computers and the more people on computers, the more money Google makes. Does that continue in a world of AI? TBD.
Right.
So it's very interesting stuff. I mean, but yeah, I don't know.
Yeah, it's all one of the things I really have struggled with, and even goes back to Meta. There was a version of this in 22 where as CapEx was starting to ramp or as spending was starting to ramp, there was a question of like, okay, but what percentage of the spend is focused on improving the core functions of the FOA business, which proved to be money very well spent versus the other things. And there wasn't a ton of clarity on what was what. And I think now you have a version of that where on the one end, and this is making it really basic, is you're just selling compute or whatever it may be. You're like, whatever the least technical piece of being a hyperscaler is, and you're competing with, Google Cloud or AWS or Azure as you do so. Then you have the surfaces or the pieces of these businesses that are unique to each company. For like YouTube or Google, for example, now YouTube has this ask feature, which I don't know if you're
Amazing.
like me, YouTube a million times a day and you're watching hour-long interviews like this one. Actually, you might go, hey, I don't want to listen to these two guys talk for an hour. Why don't I summarize the video and I can go right to the section on AI?
What does Alex think about Microsoft? It'll tell you.
Exactly.
It's amazing.
It's an amazing feature that is not relevant. There's no other YouTube. So it's uniquely valuable for them. And it's something that, again, like that's why for Microsoft, an area of focus for me has been the Office suite and the knowledge worker AI tools. If they can land that and they can monetize it effectively, they're better positioned than anybody by a very wide margin to make that a really attractive tool and a really attractive business. And it's going to widen the moat that already exists in the Microsoft Office suite. So them showing traction there is hugely important. There really isn't like a number that they shouldn't spend in order to make that happen. Because yeah, I mean, like the E7 suite I was talking about before, it's $99 a seat per month. I mean, it's a significant premium to the lower tiers of Microsoft Office. And you're talking about an install base of Microsoft Office has over 400 million paid seats. So this is very significant money if you get premiums. And as you said before, there's the lock-in component of it all, et cetera. So that's a huge question in terms of spending 150 billion. How much of it is even elective? How much of it is going to that versus something else? Can you even delineate between those things? Do you have to do both in order to be successful? There's questions there that are just beyond my ability to, I think, say things that are really insightful about. And I say that as someone who has, again, been following Microsoft quite closely for 15 years, and I've owned Meta for, I think 8 years now as well. I bought it in 2018. So it's not that I have no knowledge. I think they went from questions that were easier to answer to questions that are definitely harder to answer now. And for me, the main way that's influenced any decision-making is in terms of position sizing. They were names that Microsoft, for long stretches of time, was, if not my largest position, one of my largest positions. And I think there were periods where it was, don't quote me on this, people can look at TSOH to see historically what it was. but I think it was mid-teens kind of weightings at points in time. It's since come down to a smaller size, partly because the stock had a period where it didn't do too well, but also because I've added money over time. It's just not something where I get the sense that I'll, at least from buying shares, take it back to a 15 or 20%. I just feel like the investments have changed, in addition to your Apple kind of comment, like in addition to these companies just becoming so much bigger. And, I just think they're stepping on each other's toes more than they used to as well, to some extent. Yeah, it's always
You
a
do have to
challenge
wonder with the data centers.
being a long-term concentrated investor and figuring out what that means, particularly as time goes on.
I will say I was talking to my business partner this morning, and he works with a group. They're a big publicly traded company, and he said they just upgraded to E7, and the team kind of recommended against it because they're like, we don't need these features. It's really not important, but C-suite signed off on it, and it's millions and millions and millions of dollars. And so now they're reviewing the new tools that they have access to and seeing if they can replace any of their tech stack, which is, again, that's how Microsoft works. Like,
Yeah.
it's a huge part. There's one feature that they sell you on, and then you get all these others to help rationalize the price. And then, it's like, hey, here's all these new tools to figure out if you have a use for them.
Yeah.
So
it seems like they'll be, again, not as someone who has technical knowledge on any of this, but it seems like they'll be really well positioned in terms of protecting your data and protecting identity. We've seen not even things that the frontier companies, model companies may be doing explicitly, right? We've seen security incidents where they have not been able to control their own models, or whatever you want to call it. I'm sure even more so than individuals care about their privacy, companies care a hell of a lot about ensuring that their IP is not going outside of the walls of their organization. So I think that's a selling point that Microsoft has had for a very long time. And it's something that will probably be even more important going forward. It's not speaking to something personal, but the amount of scams and things you see anymore also are just going through the roof. So the challenge is becoming more and more difficult as well. So I think they're very well positioned in that regard.
So, all right, outside of big tech, another name, here's another name let's find something you wrote about recently. Here's a fun one outside of big tech, On Holdings. I think people are going to be pretty familiar with it. Very, very popular shoe companies. Roger Federer is a part of it.
Yeah. Yep.
So they're those shoes with the holes in it that you see all the trendy gym people wearing. They look great. People like working out in them. Talk about that position. I know the shoe industry in general, footwear industry is going through something right now. It's not a great time, but you wrote about this one recently, very different than big tech. So we can give people a flavor of kind of how you might talk about and think about those.
Yeah, it's a good example because I've been following kind of like Nike and UA and Under Armour, at one time Under Armour was a bigger player. It's a lot smaller now, but I've been following those names for a while just out of, interest in that industry and curious about the competitive dynamics, et cetera. After following Nike for a couple years and them going through the most recent, they went through a period where, I feel like backstory is probably relevant here. They went through a period where they kept presenting medium-term financial guidance, particularly on revenue growth and margins, that was kind of disconnected from the results that the business was actually delivering. And as time went on, particularly after we got through the pandemic, I became somewhat concerned that was leading to actions that were not in the long-term health of the business. In particular, I thought that they became, and this is largely anecdotal, but I thought they became far too promotional in the digital business, in the Nike Direct business, and probably for the sake of driving revenues and trying to hit targets. I just thought they were getting to a point where it was impairing the brand, and it was also training customers. If you ever go on Nike.com and there's not, you don't have a coupon code, or there's not a discount, just wait 24 hours or 72 hours and they'll email you another one because they do it every couple days. By contrast, I think in the period when I first started writing up On, I was watching closely to see how often they did this. And I went through a period of 6 months where I think they either said 0 or 1 10% off promo code. So it was drastically opposed to what Nike had been doing. This is coming up on 2 years ago now. In 24, Nike announced that the CEO at the time, John Donahoe, was, I think we can say, fired, and was replaced by Elliot Hill, who had been a Nike lifer who had left the company, I think in 2021, and was coming back to run the company. And subsequently, we got a lot of information and data that kind of confirmed, particularly on the promotional activity and in the digital space. I think I said on one call, they said, I think the call was in like early March, they said January and February of last year, we ran 30 promotional days out of the 60-day window. This year in that 60-day window, we ran one promotional day. So they're making the right changes for the business, but as you can imagine, that's a nasty reset in terms of, customer perception around those issues. So anyway, so I started following On more closely, and as Nike has gotten further down this kind of turnaround effort, and the stock's gotten beat up as well. I actually bought Nike here. Again, people can look at TSOH to know the exact date. I think it was a few months ago now. For the first time, I've been following it for a long time, but I bought it for the first time. I think it's reached a point on the valuation and on the trajectory of that turnaround to where I think we're past most of the pain, with the most prominent example being they've kind of electively taken away $4 billion of revenues from their classic footwear franchises, where they got way over their skis in terms of how much supply was out in the marketplace. And that $4 billion is relative to a base of, I believe it's on the order of $25 billion a year in footwear revenue. So it became very material in terms of the impact on the business. And obviously going backwards, they've definitely felt that pain. That coincided with tariffs and issues they're dealing with in Nike China. The P&L is basically imploded from where it used to be. But I think a lot of it's addressable, and I think it's cheap enough now to justify owning here, at least at a, call it starting weighting. I think On's really interesting as well. It's funny, the growth has been very impressive, call it like in the mid-20s% annualized range, I believe, over the past couple of years. When I first wrote it up, I mentioned it in that piece. I think it was 2 or 3 years ago now that I first wrote it up. The stock hasn't gone anywhere. The results have been good. I think the market is somewhat tentative about what the path looks like going forward for that business, and this tough question in athletic apparel. And it harkens back to what I was saying on UA a moment ago, which went through a very similar issue. You probably remember it was a super hot stock in early to mid 2010s. And then the bottom kind of fell out as distribution and the brand got out of whack with where it kind of needed to be. And then they built too much of the infrastructure for the size of the business. And they've been in some form of kind of rectifying that for at least the past 5 years. So it's a business where you really have to be thoughtful about how quickly you grow, where you grow. How do you deal with inevitable periods of excess inventory? Do you burn the product? Do you sell it at a discount in the channel and potentially hurt your brand? There's tough decisions to be made, and it requires a lot of working capital as well. Yeah, it's funny. I think I concluded in the On piece. I said basically, if I had to pick a side, I lean towards this being something I'd be willing to own and the price being reasonable enough. That said, he is such a new position for me that I kind of want to be thoughtful about how quickly I'm moving into this space. And there's also there's things going on in a couple different players as well. And I don't think it's unfathomable that a number of them hit a difficult point at the same time. So wouldn't be the worst thing in the world to own both of them if they got cheaper. I try to be really thoughtful about to the question before about some of these things and kind of like risk management and stuff. That's the kind of stuff I tend to be really thoughtful about in terms of the timing of at least layering on very similar bets at the end of the day. So, yeah, I'm curious if you have any thoughts as a consumer, investor, or otherwise.
With On, it's been growing really quickly. Nike, so with both, I own Crocs, which is very different, and Deckers, which is not very different. So Deckers is basically 50% Uggs, which people are familiar with. And at this point, that's more of just like a brand that they slap on things. There's the Ugg boots, of course, but the blankets, stuff like that, just means soft, cozy things, really comfy stuff for girls generally. Mm-hmm. My wife loves it. And then then Hoka, which is a running shoe. And so Nike, so I'm a runner and I kind of got into running shoes. Over the last couple of years since COVID, I started becoming more of a distance runner. And Nike, they absolutely dominate the high end. So like whoever wins the marathons this year, they're going to be wearing those Nike 4%, whatever they're called, shoes with the carbon fiber plate. Those are like $350 shoes. I'm sure people buy them for the 5Ks. They really don't need them. But for the most part, unless you're like a very serious runner, it's a good brand sign that Nike wins those races. And that's great. After that, to me, it's still the coolest brand, that check mark. But I don't really see where they fit anywhere else because they're not, if you go on any like running shoe site, they sit kind of right in the middle with everybody else on, you're going to get recommended Brooks, you're going to get recommended Hoka, you're going to get recommended ASICs sometimes. I mean, there's On will be there for like more of a gym shoe, but it's unclear to me where they sit as to why would I recommend a Nike? What Nike am I recommending? You kind of just go based on how it looks and you're trying to look cool. So like if you want a sneaker to wear out to like a happy hour or something, Nike's probably your bet if you're wearing a sneaker. Great. I don't know a ton about basketball shoes, so maybe if you're playing basketball or working out, then, maybe Nike has a position there. I'm not totally sure.
Yeah,
It's still,
their position in basketball is a lot stronger than in running.
okay. So I'm unfamiliar there, but even that, how many people are buying basketball shoes? The running market has to be a lot bigger. And then with On kind of seems like the trendy. It's a new trendy brand, and it does kind of remind me of Under Armour. It's very cool. Because of the holes, it's very distinctive from far away. If you're kind of a stylish person who wants to work out, people do like them. So I know they get great reviews. So they stand out on that front. Pricing wise, I think they're at the higher end of a normal shoe for working out. Outside of that, I don't really know what they're great for besides in terms of pure performance, but they do look good. People like wearing them and they stand out. So like you can see that it's an On shoe. I don't know if people are going to be like On shoe wearers forever or if this is like just the new brand that they're like people love. There's an emotional attachment to that swoosh. Just Do It was a powerful campaign. Jordan was not jumping in, anything. He was wearing a Nike swoosh. And you have that in your head. So yeah. So again, it's a good brand. We'll see. It's a tricky world to navigate. So like Under Armour you brought up in 2015 or 16 maybe. I woke up one morning, the stock was down like 45%, and I got excited because it is a good brand, and I grabbed the 10K and I read through it. And their inventory management was just an absolute mess. And the 10K was actually good. I mean, it spelled out what the problems were, and they were serious problems, which I don't know what you would do to fix it, and they really haven't fixed it yet. So, On kind of, I'm not saying they're in that position because Under Armour was also doing some illegal things with their accounting, but as well as some other cultural issues. But I'm not quite sure where On sits. Hoka, I was a little more comfortable with and I purchased because Hoka basically means cushion. So there's only one type of Hoka shoe, and it's a cushioned shoe. So if you have knee problems, I can recommend a Hoka to you. If you're new to running and you want to have something soft or you're going to stand on your feet all day, I can just recommend a Hoka. You can't really recommend a Nike or an On because you need to recommend a specific make and model, or like a New Balance. There's specific make and models that'll work for you. Hoka, you can just say, like just get a Hoka and it's going to have cushion in it. Is that necessarily good for you? That's a whole separate thing. But the brand means cushion. And so I like that position because a lot of people, in the market, I like that brand position because you can just recommend it. You can just say, Brooks means running shoe. If you just need a whatever running shoe, you get a Brooks shoe. You're good. So I'm not sure where On sits in that and how to like just say go get an On shoe. I mean, if it's just a gym cross trainer, I guess maybe any of them would work, or a tennis shoe. Maybe it's more powerful, but that's when I kind of got comfortable with the Hoka brand. Also, not to mention the highest margin shoes and most expensive shoes, you pay for cushion in running. So they also sell higher margin, big, shoes. So it's a good position to be in. So yeah. So I guess that's kind of my take from someone that just works out and looks at the shoes. I'm not too familiar with them, but yeah, I mean, Nike's such a powerful brand. I mean, it's not going to be, you absolutely can fathom the turnaround story. And they've been, even today, they're earning really high returns on equity capital for a long time now. So, and the stock's getting pretty cheap. So you have to be, plenty of opportunity here.
It's funny. I think about this a lot in terms of Nike and a couple other businesses. There's this somewhat famous, this back and forth between Charlie Munger and Warren Buffett at I believe it's the 2000 Berkshire meeting or 99, one of those, where they essentially talk about this issue of the competitive impact of the internet. And they basically say something like, they both agree that they basically think it's a net negative for businesses, American business generally, because it's going to raise competitive intensity basically. And the benefits are going to be outweighed by some of the costs. And I think Nike's an interesting example of, you kind of think of 25 years ago, their ability to segment different channels whether it's, I mean, using the current landscape, whether it's a Dick's Sporting Goods or an outlet or other channels that they might be in that are not sporting goods stores, and what products you put where and what the pricing looks like and your ability to have that not be particularly visible. We're in a completely different world now. And it makes the challenge of, a business like On is so consistent in terms of we are a premium brand. And you go on there, as I said before, like it's very rare that you'll see them discounting anything. And you go on their website, and I talked about this in the latest Nike update. You go on their website, the cheapest pair of shoes that they sell for men is $140. Nike starts selling shoes in the $50, $60 price range, and they have from 50, 60 up to, as you said, they go much higher than that, but they're serving such a much broader base. And you think about apparel, you're selling, tech enabled, heat resistant cooling shirts, whatever it may be, on one end of the spectrum, and then you're selling $15 cotton t-shirts with a logo slapped on it at the other. And it's just it's a 50 billion or close to a $50 billion business that has huge breadth in terms of the range of products it sells and the geographies that it sells in. And then you look at something like an On that's, call it a $3 billion business, and the vast majority of their business is shoes and primarily running shoes. Now, as they're growing over time, that is changing.
See some hats and stuff. Yeah.
They're getting into apparel a little bit, and they're getting into tennis, and they want to be a lifestyle brand. They still want to do that all in the wrapper of being premium, but there is a constraint on how big you'll be able to get living in that sub-market as well. And at that point, you'll have to make a decision as a CEO or manager of the business. Basically, are we staying here, which is probably the right decision, or are we going to try to find ways to stretch our boundaries a little bit more? Yeah, it's a really interesting space. Yeah, I'll be very curious to see how the next couple of years go here. As I said before, it's something I bought fairly recently. It's definitely a smaller position for me, and I don't get too worked up on at a point in time how the valuation looks compared to, is it super cheap? As long as it's in a range of reasonableness, I don't overly worry about the valuation. It is an industry where the competitive dynamics are noteworthy. Their position, the stability of their position is not something that I rank as highly as I do for some other names in the portfolio. And that said, I would add the one asterisk that, and you see this over time with companies like Under Armour. Under Armour's, one of the things that the founder, Kevin Plank, said that always stuck with me was he talks about a period early in the company's history where they had like pink sports bras made or something like that. And he got the product and he was like, something is just wrong with the product's not what they thought it was going to be. And they had the choice of either selling it at a discount or like literally lighting the product on fire. And they just threw it in the trash and ate the investment. But you run into that issue constantly in this business, and you do it enough times of liquidating things in a channel or moving your brand beyond where it should be, and that perception changes significantly. And as Under Armour's kind of shown, like it's really, really difficult to claw that back. I don't think that brand can probably return to where it felt like it was going at a point in time. I just feel like that's kind of complete. I mean, you think of the point where is in a relatively brief period, it feels like, where they had Steph Curry, Jordan Spieth in golf, who was taking over the world in golf, and Under Armour was not a golf brand at all, at least the perception, right? Felt like they were taking over the world a little bit, and that just feels like it's completely out of reach now. One final thing on Nike, the one benefit of being so much larger than everybody else is you do have more money to spend, and you should presumably be able to do things with athletes that well, you should be able to get anybody you want, for one, and you should be able to do things with them that nobody else can rival. So I think they got a little bit away from that. And again, this is during that period where I thought the financial targets were causing some suboptimal decision making. It's during that period where they let someone like a Roger Federer go. And I think you look at him and you go, this guy's a Nike athlete for life. And whatever it means in terms of figuring that out, you figure it out. And they didn't do that. And he met these guys in Switzerland and took an equity stake in On, and, the rest is history. So yeah, as I was saying before, on business quality and management quality, management decisions are bad enough. The business quality is going to start to show signs of that fairly quickly.
Yeah. I think I agree with you about the on brand and the extent of where it can go. We'll see. But because it's again, it's the cool brand right now. Like you are a little bit different. If everyone in the gym was wearing on, so like this right now in my mind, it's the stylish. So like my sister in law is very stylish and she wears them. That's kind of their target market, and she wears them to work out. She's not going to pay 300 for her workout shoes. She'll do that for plenty of other shoes. But for her workout shoes, she's not going to pay like 300 or two. Maybe she can get up to 200s. But, she's working on her in her basement. No one's even seeing her. So she's not going to, go too crazy there. But yeah, right. So, how much upmarket can they go if they're going to be the luxury brand? And then how far can that spread? It's a question mark because it's really just a cool brand. And from my perspective, that's really all it is. It's I don't think they perform the best. I don't think they're selling you on the, they're high quality. Users like wearing them from what I hear, but you're not winning the marathon in 'em, and you're not jumping higher in 'em. You're, it's a workout shoe. So does it compete with the Nike sneakers like out and about? I would probably guess yes. You could probably do some of that. But it's kind of like the same. It's almost like opposite network effects, whereas like we can all show up in Nikes and for some reason that's okay. But if we all showed up with like holes in our soles, I don't think I think one of us would start buying another shoe. So who
Yeah.
knows?
Yeah.
Unlike another one you've written about that I own, Crocs, who has lots of 13 holes in their shoes.
Yeah.
I almost think there's opposite now. I think they do have network effects in a positive way there. Very different
Huh.
than the other ones. Talk to me about Crocs. I know you've written about them, and I think so. You had on April 6th this year. You were about Crocs, the Hey Dude Hangover. That's when I
Yeah.
purchased it. Was when they did the Hey Dude write down because I was looking at it a little bit before, and basically in my head I agreed about the write down, and then they went ahead and wrote it down, which I've never had it happen that quickly before. And I said, hey, actually, I disagree with the market on this one. I think they did the right thing here.
Yeah.
So talk
Well,
to me about
first of
that.
all,
Do you own any?
I do not. First of all, very good call on your part. I concluded, you can keep me honest here, but I think the sense of my conclusion was in the most recent write-up that I think the valuation is attractive. And I think the core business on the numbers defies a lot of the claims about Crocs and particularly things like fad risk. And it's fun as a big part of my write-ups, particularly when looking at a company for the first time, I do a ton of reading through any like old Bloomberg articles, old Wall Street Journal, or if I can find anything written from 5, 10, 15, 25 years ago, I love to read those type of things to try to get a sense for like, what was it like owning this or being in this business at that point in time. And Crocs is one of those funny ones where, like, perpetually when you read things, there's two things that are always mentioned: fad risk for these types of shoes, and two, just like competitive threat from knockoffs of, these same foamy looking sneakers or sandals, whatever you want to call them. And then you look at the business results and they disclose a number of units sold and the ASPs as well, obviously, and the revenue. So you can look at it by volumes and pricing and things like that. And it's just an extremely impressive track record of what the core business has done over the past roughly 20 years. So I liked what I saw there. What I didn't like as much was the Hey Dude deal. And, when they reached a point where the numbers were really starting to fall short of the expectations that I had laid out previously. And as you said, like, it was pretty clear, like, obviously there's impairment here. What do you do from there? And I followed companies like, bring this full circle in a second. I followed Dollar Tree for a very long time with a somewhat similar idea of I really like the core banner. I think it's a very unique retail value proposition. And I think the products they sell and the customers they serve is a lot more insulated than people think because they just view it as retail being competitive, which it obviously is, but there's different occasions and use cases within there. And Dollar Tree's position is very well insulated from what a lot of others are doing in the space. But they own Family Dollar, which I thought was a very bad asset, particularly relative to DG, which is their main competitor. And it was a turnaround story that wasn't turning, and it was taking a lot of capital. It was taking a lot of management's time and resources. And from having watched that, maybe this is a rule that I have to tweak over time or at least be thoughtful about. I just came to a place where I was like, I don't want to own this until they clean this up. They need to figure out an answer here. And until they do, I'm someone who's going to own 10, 15 stocks at any given point in time. I don't need to make a compromise like that if I don't have to. In that case, it managed to work out well where they did get to that point. and the stock didn't trade great in periods shortly thereafter. So it gave me an opportunity to buy at prices that look really good now. So I think in some ways I was looking at Crocs similarly, and obviously we'll see how things go from here. I'd prefer that they just were not in the Hey Dude business. They sold it for, they might take an 80% haircut on what they paid or 70% haircut on what they paid for the business. But I like the idea of teams just getting rid of things that they don't want to be doing. Obviously, you don't want to repeat that cycle and over again if you're just going to get rid of things at fire sale prices, right? But just get rid of that businesses you don't want to be in, get rid of the distraction and focus on what you're good at and focus on maximizing per share value with that core business that has proven to be, a growth business with legs internationally, with a lot of things going for it. Has things going for it with Gibbets, which for people who don't know are the little accessories. Like, there's a lot of things that are going well there, and stock has, generally speaking, traded at a pretty attractive valuation. So you have opportunities on capital returns, et cetera, et cetera. So yeah, that was kind of my conclusion, but I think I probably wrote that at 80, and last I saw it was at 120 or 130. So maybe I should have accepted. I should have accepted owning Hey Dude as part of that, but that's the way it goes, right?
Yeah, no, it makes perfect sense. And it's probably the biggest position I've ever had that I was the most afraid of because it's such a stupid product. But it is
Yes.
powerful. Yeah, I'm comfortable with it. It grew to be a pretty large holding of mine, that and Deckers. Deckers is way less risky because the company has, I think, zero debt. If
Yeah.
they have way more cash than debt. I think they have like 200 million of debt and like a billion plus in cash. So on that front, Crocs is a little different, kind of normal debt structure that you would see. But yeah, I mean, the product is just so silly that you're always kind of nervous. Like the world would totally go on if everyone just stopped buying these tomorrow.
Right.
So I
No,
don't
it's
love
always
that
funny.
aspect.
It's always funny on companies that you do work on a new name. And I think like a lot of times my conclusions from initiation will be, here's what I kind of like about XYZ business or management team. Here's why I still have some questions. Pretty rarely is it, I'm going to buy today. That probably happens like maybe 5% of the time, if that. Usually it's up. I want to see a few things develop over time first, but I will give a sense for the valuation of, I think at whatever, $50 a share, this starts to look pretty darn interesting. It's funny when companies get there, when they trade down to those prices, like you're saying with something like a Crocs, you really have the test then of how you feel about now making that decision. And sometimes you get to that price that you thought was the price you wanted, and you're like, well, the price looks okay now, but my feelings about the business are really they're starting to become a bit clearer, and they're not maybe as great as I thought they might be at this price.
Yeah, I lost a lot of money at first in Krog. It kept going down and I kept buying more. And there was a point where this is even worse. I was like, all right, well, maybe I'll buy a pair because adults do wear them. I go out, you'll see adults wearing them if you look around. I mean, especially down in Florida, I bet they're everywhere. And it was just so stupid. I can't do it. I can't answer the door. I'm an adult. I can't answer the
Yeah.
door wearing Krog or like my neighbors see me. So, and then you're like, I'm really going to invest all this money in this brand that I literally won't buy myself. But
I bought a pair as part of my research, and I put them on once, and I thought they felt okay. But yeah, I have not worn them to the grocery store or anything like that yet.
you'll see adults. I'm sure you do.
That said, I have a young son, and I take him to the park obviously a lot, and I notice a lot more people wearing Crocs now that I've done work on Crocs. They do seem to be quite popular.
Yeah.
I don't get down and ask people like, are those legitimately Crocs or are they a knockoff brand? But yeah,
I,
they are popular.
I can see from afar. I've gotten good at
Yeah.
that. I've learned how to tell. But yeah, so we can kind of work on wrapping this up. You write about all sorts of awesome stocks. I mean, so it's not obviously it's big tech. It's everything that an advisor's client would want to hear about. But just like going down the last couple ones that you wrote: Microsoft, Ally Financial, Netflix, On Holdings, Comcast, Nike, Ollie's, Tractor Supply, Tutor in Your Pie. Is that Duolingo?
Yeah, Duolingo I read up recently. Pretty
Markel, very
fascinating
very
story.
cool. Sorry, go ahead.
I was just saying Duolingo is a pretty fascinating story. It's an interesting company.
I have a 550-day plus streak going currently.
Really?
I don't know much Spanish, but
Are you
I'm
on the
still
paid
going.
or on the free tier?
I'm on the free tier.
Okay. Yeah, it's not to divert this conversation too much, but these guys I understand their mission. They very much want the world to be able to learn and preferably for free. But I think how they've figured out differentiating between free and paid thus far has been a little bit underwhelming in terms of driving the business results. And I think they need some work on that over time. But anyways, that can be a discussion for another day.
Yeah. Well, I would love to dive in on that, but we're running out of time here. Markel's great. Dollar General, Dollar Tree, BJ's, Airbnb, Disney, Peloton. The list goes on. Great resource to check it out. So the signs of hitting. It's on Substack. Search for Alex Morris. Post stuff on I think what Facebook. Where can people find you?
Main place is Twitter, LinkedIn as well. I use the Substack notes feature now. People can email me directly, scienceofhitting@gmail.com. Yeah, you name that long list of companies. If people are subscribers and they have names that they'd like me to look at, and it's something that is reasonably within my wheelhouse, I'm happy to do that as well. So yeah, I think it'd be a good fit for a lot of RIAs. And if there's ways that I can add value to them, I will consider working with them individually or changing the product. It makes sense to. So feel free to reach out to me. I'm very flexible.
Advisors want talking points with clients, and Alex can give you great talking points about basically any stock. We both kind of nerded out about some stocks. Who knows? Maybe we go deeper. Maybe you want to go deeper. I'm sure Alex can do either one. So feel free to reach out to him. Hey man, do you go to Berkshire every single year? Do you ever go back, or are you done with that?
I'm going to go next year. I didn't go this year because my wife had our second child, so we were.
Congrats!
It was a fire here.
Congrats! Yeah,
thank you. But yeah, I'm going to be back next year.
All right. Well, maybe we'll meet up. I go all the time, so we'll be nice to meet you. But hey, thanks a lot for doing this. It was a lot of fun, and yeah, we'll catch up soon. Thanks again
for having me. Great time.